Wednesday the 29th brings the first FOMC meeting in the wake of Donald Trump's re-entry into the White House. So what can we expect from this? I'm going to take you through a whole raft of really interesting charts to signal exactly where the US economy is at the moment and what that might mean in terms of the outlook for interest rates going forward. And then we'll be talking through what this means for the likes of the US dollar and for US equity markets. So first and foremost, it's important to hammer home the fact that markets are expecting nothing when it comes to a decision from the FOMC and to potentially cut rates. We're not looking for that to happen. 99.5% chance that we see rates held at 425 to 450 this time around. And certainly this meeting is really one where we're going to try and gauge exactly what the outlook is for the year, really, because the US economy is in a good position. The jobs market looks decent enough. We've got inflation where there's still concerns, and particularly with Donald Trump coming back into power, people questioning whether he is going to incite a new round of inflation. And so there's significant questions that need answering, and maybe we're not necessarily in a position to do so at the moment. A lot of it is really speculation more than anything. And so the question mark for markets really is, what's the outlook for the rest of the year? Because recently we saw a move lower in terms of core inflation. People started to think, maybe things are all right. Maybe we'll see a decent amount of rate cuts this year. No doubt Donald Trump's going to be pushing for exactly that. But that doesn't mean that that's what he's going to get. And certainly the Federal Reserve can probably think that they're in a position where they can maybe just take the foot off the gas a little bit and see if Donald Trump wants to take the next leg of the journey. So here's the expectation for this year as a whole. And you can remember, we're at 425 to 450. So the base case scenario, the most likely scenario, is one single 25 basis point cut this year. Beyond that, you can see, 30% plus 14% plus sort of 4%. So there's roughly near enough a 50% chance, a little bit less than that, that we see a second rate cut this year. Market's not really expecting much beyond that. So let's look into sort of the data and see exactly why markets are pricing that at the moment and what might potentially change that narrative. So this is where we stand at the moment. So you can see this is over some decades, and we've got this downward trajectory gradually in terms of rates. But in actual fact, this time around, we saw a much higher jump in terms of interest rates for the Federal Reserve. And as we can see here, the 2-year, the 10-year, generally bond yields will track roughly the trajectory for interest rates. So with the expectation of lower rates this year and next year and the year after that, those rate cuts are expected to drive down bond yields, drive down borrowing costs. But we haven't necessarily seen that to a great degree. And that's been one of the major concerns recently, certainly massive ramp up in spending around the pandemic. So the likes of the UK government, the US government, they're in debt, right? And that debt is not easy to maintain, because when it rolls over and they have to pay for it once again, well, borrowing costs are through the roof, and we haven't seen them necessarily come down. So that is one reason why the Federal Reserve will need to cut rates further, because one way or another, we need borrowing costs to come down for the government, if anything, and for the Treasury to be in a good position. Otherwise, that pile of debt that they've got is going to soar. But at the moment, there's of course a risk that if we see a resurgence in inflation, then that's going to be even more damning than the near-term rise in terms of borrowing, because that ultimately leads to the possibility of higher rates, and then we see ballooning yields once again. What we have seen recently that's notable is this uptick over the course of recent months in terms of the economic data. So the City Economic Surprise Index, you can see that we're weakening for a significant period over the course of last year. That has actually turned recently, moving towards the upside. Generally, that strength comes alongside strength in terms of bond yields, but actually bond yields moving lower for sort of half of this recent recovery. But this points towards that narrative around the US economy starting to do well once again, and people feeling relatively confident. Now, this is where it stands in relation to some of its peers when it comes to unemployment. So, is the jobs market screaming, we need rate cuts, right? It is for some areas, it's not for others. So Canada at the top of the pile here, and we've got a relatively steep ascent in terms of that rise in terms of unemployment, roughly around that 7% mark. Then we've got sort of Eurozone, it's high, but it's moving towards the downside. New Zealand moving up and actually at a decent pace. And then we've got the UK, which is sort of near enough kind of flatlining of late, but it had risen a little bit. But, I would say generally under control in the fours. And then we've got the US in that sort of pale green line above the 4% mark. We rose a little bit. We haven't really seen a sort of lift off in terms of unemployment. So you would say that the jobs market, by and large at the moment, looks in decent shape, right? We're not necessarily seeing something that's going to force the hand in terms of the economy there. Then if we're looking at a leading indicator of what the economic conditions are and how strong is the economy right now in the US, you'll be looking towards the PMI number. So the ISM number is particularly good because the ISM PMI gives you a number of underlying metrics as well that we will be able to show you. So as we can see here, the manufacturing sector has by and large over recent years been the area that's been very weak. Services has by and large been the driver of inflation. So services probably most important here, but you can see here manufacturing also moving sharply higher of late. And so the last reading we saw a bump higher in terms of both manufacturing and services, manufacturing moving towards that 50 threshold that denotes a sector in expansion, still in contraction at the moment. But nonetheless, both moving in the right direction, and in particular, the services sector, very strong there. So this is a breakdown in terms of some of the key metrics within the services PMI figures, the ISM services PMI. So employment, it's in the green, so it's above that 50% or 50 threshold. All of them are. But it's not going crazy. New orders, again, decent in the sort of mid 50s. Business activity, we've seen an uptick of late. Prices paid. That is where we've got potential problems, right? So if you're looking at a strong ISM number, there's different elements within it. Part of that is prices paid. So you could see a really strong ISM services PMI, and you think, great news, and you look into it, and it's like, oh, the strength comes from prices paid, which is inflation, essentially. And so services inflation has been the driver of inflation as a whole. And as we can see here, the most recent ISM services PMI does point towards prices paid within the services sector on the rise. And if you tally that up with the year-on-year CPI reading in the US, what you can see here is that the services, ISM services PMI, prices paid element generally leads inflation. And you can see it here, right? If you look at the sort of midpoint of it, it's that move towards the upside that we've seen in terms of the red line in the middle of the chart. And that ultimately led us into a surge in terms of headline inflation. Then once we saw the prices paid element moving lower, a few months later, you start to see the same kind of thing happen in terms of CPI. So this is a warning sign. It really is. And the Federal Reserve will be aware of this resurgence in terms of inflation, and they're not going to just continue to cut rates in the face of a potentially strong economy under Donald Trump. He's going to enact a raft of policies of which they're probably going to want to see, and they're going to want to see what the repercussions are. Tariffs, how much is that going to import inflation, goods inflation in particular? These are key elements, especially given at the time where that prices paid ISM services PMI element has surged towards the upside, and historically that leads headline inflation higher. This is a breakdown in terms of the headline CPI and then the core PCE. So the Federal Reserve's favored core reading and then the headline number. What we can see here, certainly in terms of the green line with the headline CPI, is that on the monthly metrics is climbing up and up and up. And we want a roughly 0.166 recurring figure, right? So any number around 0.1 and 0.2 on a monthly basis takes us on a path back to target. But what we're seeing at the moment doesn't point towards that. If you're talking about the possibility of a resurgence in headline inflation, this is showing you exactly that, because the last 3 months have just got higher and higher in terms of the monthly metrics. So near-term annualized inflation certainly on the rise. Notably at the bottom, what you can see is, I often talk about this, right? So you can see these sort of chunks of inflation. The left-hand side of the middle chart here, we can see some very strong bars. And so when they are dropped out and when we see them replaced with new data, where could we be? And so what I've done here is I've done of course, because we've got this green bar, but we don't have a yellow bar next to it. So we've got one more CPI reading over and above the PCE. So I have done, I think I've annualized 1, 2, 3, 4, 5, 6, 7. So I've annualized 7 PCE months and 8 CPI months to show us when we get to the end of April. So when we're in May and we see April drop out, where are we going to be in the mid part of the year? At the moment, we're still on track to get CPI down to 2.15 and PCE down to 2.2. So there are concerns over the recent trajectory in particular of headline inflation. But if all remains, as is, and we average out how things have been over the past, say, half a year, then by the time it gets to May, inflation will be under control. And therefore, we're pointing towards, not that many rate cuts this year. Well, that we might see more, and they might come at the back end of the year. But certainly, we need to see exactly how things play out over the next few months, in particular, because we have started to see inflation rising, but those base effects are really going to help things once we start to see the likes of that January core PCE figure dropping out in particular, and the February CPI figure dropping out, same as March and April, big numbers there to drop out. And hopefully that can benefit us in terms of seeing disinflation coming into the fold. When you're looking at US inflation compared to some of these others, I like to utilize the annualized figures, because the annualized figure would be, for instance, we look at the last 3, the 3-month annualized would be the last 3 single months, and saying where would we be over the course of a year if we stayed on that track. So it really shows you, if you're looking at 1-year inflation rate, which is 2.8, 2.9 at the top, we can see that just shows you what all of the inflation in 1 year. But I want to know what's happening in the here and now. Are we actually tracking higher than that? Are we sort of running hot right now? But the weakness from 7 months ago might sort of keep figures lower. Or are we actually seeing a really nice move towards the downside in terms of near-term inflation that down the line will really take effect to drive down inflation? Well, it's notable here that we can see here on the core CPI figure, we've seen a move towards the upside in terms of the US number, 3.2 now, significantly higher than some of the others. And then you can see here on the 3-month annualized, we've also got the US at the top end of the pack here when it comes to 3.3 on the 3-month annualized. So whilst we're saying that in May, the annualized 7-month annualized, 8-month annualized would point towards us possibly getting closer towards 2%. If you actually look at the figures for the last, say, 3 months and last 6 months, you'll notice that we're well above that. We're in the 3s, and that is problematic, and it's going to be something that the Federal Reserve will take note of. You can see 3% on the 6-month headline inflation, 3.9 on the last 3 months. So the last 3 months of US headline inflation have been a big problem. And you can see it exactly here, right? That's those 3 big green bars in the middle. Massive inflation, and each one of them is over and above where we need to be able to get back down to target. So inflation appears to be a problem. Part of that is going to be energy, right? So, what changes between headline inflation and core inflation? One of the major parts and one of the most volatile parts is energy. And we have been seeing a move higher in terms of energy of late. But Donald Trump, one of the things that he has done since he's come in is declare this national emergency around energy and saying that they're going to be pumping a huge amount of oil and gas. Well, at the same time, going to fill up their SPR, so that means more demand. But nonetheless, we're talking about the possibility of rampant production in the US in terms of oil and gas. And so if you look at this chart, it's, let me just sort of guide you through it. First and foremost, we've got the monthly readings in green for inflation, right? So you can see that on the right-hand side. So this green line, what we need is this green line to be around about 0.2 or below, like I said, because that gets you on target to try and get towards that 2% inflation target by the end of the year. So 0.2, that's where we've drawn the line. So we need that green line to be below that 0.2. Anything above it means that we're running hot, right? And that's where we are at the moment. We're running hot on the latest figure. Then I've got the orange line, which is US crude, but it's quarter on quarter changes. So what's the change from 3 months ago in terms of crude? So it's not just showing crude and its trajectory, it's going up, it's going down. This is it comparing it to a few months back. And so what you can see here is that we generally see these sort of swings. And what we've seen is this rotation towards the upside of late. That's been represented with the latest month-on-month inflation figure. But Donald Trump has managed to drive down energy prices to an extent. This is why the likes of US crude prices are really key when it comes to inflation expectations. So if we can see more of that, if we see further weakness in terms of the energy markets, then that's good news, because that certainly helps when it comes to the headline inflation figure and getting it lower. In terms of some of the markets, let's talk first and foremost in terms of the US dollar. We've seen a big run up so far, and a lot of that is down to fear, right? We don't know exactly what's going to happen in terms of Donald Trump's policies, in terms of what they're going to do to the economy, what they're going to do in terms of inflation. Will he manage to keep a lid on it? We don't necessarily know. And so that's why at the beginning of, post-election, we saw this big bump in terms of the US dollar. The US dollar is a haven. The US dollar is somewhere that we generally go to when we're fearful, right? And so markets very fearful. They don't know how the tariffs are going to play out. We don't know how inflation is going to play out. So we see this bump in terms of US dollar. Bear in mind that uncertainty and concern is also reflected in expectations around inflation. And of course, if we see high inflation in the US, then you're looking for potential differentials in terms of expectations from the Federal Reserve versus, like, say, the ECB or the Bank of Canada. And so that strengthens the US dollar. But we've started to see it roll over just around the same time that we saw the same thing in the wake of Donald Trump's victory in 2016. So early 2017, we started to see the US dollar rolling over in terms of the dollar index, and we're starting to see that here once again. We don't necessarily know if that's going to last. This is, a potential blueprint, but it doesn't mean it's going to play out exactly the same. I'd be very surprised if it does. But certainly we have that initial fear, and it's starting to fade somewhat. So, the question mark here is, do we see further weakness in terms of US dollar, or will this meeting, this FOMC meeting, really hammer home the fact that they're now thinking they're going to pause for some time, and that they're going to essentially start to look towards the data once again and become data dependent? So let's look at Donald Trump. Let's just sit here and hold our hands under our bums and wait for Donald Trump to do something, essentially. So let's see what the repercussions are. One of the charts I think is really interesting here is the likes of the US dollar against the Canadian dollar, in part because of the CAD is highly correlated to energy prices. So if we see continued weakness in terms of energy, which is something that Donald Trump's trying to do, then that is good news here in terms of dollar CAD, in terms of driving it higher. Then we've got the likes of the effects of those tariffs. So there's talk of 25% tariffs coming into play here on the 1st of February alongside against Mexico. So again, that's something to be a little bit bearish for the Canadian dollar. Now, if we're looking at potential weakness, as we saw with that previous chart, then this probably isn't the greatest chart to be looking at. But if we're looking at this meeting, in particular with the FOMC potentially coming through with a rhetoric around the possibility of holding off, being more data dependent, they think the economy is in a good position, they think the inflation could rear its head once again, in particular with some of the policies that Donald Trump's looking to enact. All of that points towards the Fed doing very little this year. And like I said, there's a possibility at the back end of this year, the second half of this year, they're actually in a position to do a lot more. But the recent resurgence in terms of inflation does point towards them being hesitant. And therefore, I think Q1 coming into Q2 is likely to be dominated by FOMC hesitancy, which could be good for the US dollar. And so as you can see here, we've got this little range really in play at the moment here for dollar CAD, sort of 1.446, 1.43, that kind of area, set within a wider bullish trend here for this market. So I wouldn't be surprised to see a further upside coming into play as we rotate around these zones within this range and potentially come back up into the top end. But really it comes down to the outlook, because like I said, we're not going to see a rate cut this time around. Market's pricing at near enough 100% chance of that rate pause. And therefore it's a question mark on, where do markets perceive the next cut to be? And I think it's likely they're going to take a pretty cautious and patient approach in my mind. Then we're looking at US equity markets. And so US equity markets generally are driven by a number of different things, right? To some extent, they're driven by the Federal Reserve and the outlook for interest rate cuts, but not in totality. And certainly I would say less so than, say, the US dollar, like the currency markets and bonds. Because if you look at this chart, essentially the stock market is a reflection of the growth in earnings and the perceived growth in earnings of US companies. Granted, when interest rates are cut, there's an expectation that we see greater growth for those companies. So they do go hand in hand. But you're looking here, earnings per share, but the 12-month forward. So expected earnings per share going forward. And part of that is Donald Trump coming into power and people are feeling good. And, these new policies and great. Okay, people revise their outlook for earnings going forward. But essentially, the S&P 500, the reason why it keeps going up is because US businesses continue to grow and continue to create greater earnings per share. And part of that can be down to things like buybacks, or the decision to sort of cut down on the amount of shares that they've got. There's a number of reasons that companies can drive up their earnings per share, limiting the amount of shares they have or raising the amount of earnings that they're having. All of this really feeds into this continued growth in terms of EPS, forward EPS, and that drives the S&P 500 higher. And that's why the S&P 500 is such a good, strong performer. And people say, well, it's just because everyone wants to invest in the US because it's, the place to be. These companies continue to do really well. And generally, the biggest companies in the world and the fastest growing companies in the world are domiciled within the US. And that's why we get this never-ending uptrend, right? And we see pullbacks, but we're back at record highs once again for the S&P 500. I'm going to show you first and foremost the chart for, well, actually, let's jump onto the S&P 500 first. So here's the S&P 500 in its current format. Let's look from long term, it goes up, right? You might get the odd down month. If you're really unlucky, you get 3 down months. Certainly, if we're all locked at home, then you might see more protracted moves. But generally, over multiple years, you'll see, 4 up months, 1 down, 4 up months. On this occasion, we saw a market crash. Then we saw 5 up months, 2 down, 2, 1, 3, 4, 5, 6, 7, 1 down. So generally we see the pullback of last month as an outlier set within bullish trends. And so you can see here 1, 2, 3, 4, 5 up months, 1 down. 1, 2, 3, 4, 5 up months, 1 down. 1 up, 1 down. And now we're going once again. I think there's a good chance that we just see same kind of thing, right? And this uptrend should continue. And we're in earnings season. So this is key, right? The expectation, the outlook for earnings will be updated as we go through this Q4 earnings season over in the US. So on the near term, we can see things are sort of looking like this. You're going to see sort of strong moves higher, then a bit of retracement or a bit of chop, and then the next leg higher. And the same kind of thing, right? So essentially, we're in another potential retracement / chop mode, and therefore you're going to be looking out for some sort of retracement. We don't necessarily know how deep this retracement is going to be. I'm going to put all of them on, right? The fib level. So we've come into the 23.6 thus far. There's no guarantee we even get down to the 38.2 because ultimately, we see shallow retracements, we see deep retracements. It's not necessarily a huge amount of consistency to it. So there's different ways to play it. I like to go long on breakouts through the prior high when we see shallow retracements, because then I can put stops very close, because if we see just a 23.6 retracement, I like to put my stops below that level on the breakout. Or if we see a deep retracement, then I like to open my trades at US fib level and then put my stops below the price swing low. If you see a mid-size sort of 50% retracement, you could see an ABC style retracement into the 50%. Then I'll wait for a break up through the price swing high and then look for either a pullback to get into, or just enter on that break through the price swing high and put my stops below the 50%. So different ways to do it. But ultimately, my view is that this period is going to be a retracement once again before the bulls come back into play and we see record highs for the S&P 500. And then, like I said, another market to be looking out for here is the Russell 2000. The Russell 2000 does well when interest rates are cut, in particular, because it's highly reliant on borrowing. So rate cuts bring lower borrowing costs. But same kind of thing in terms of yields, right? So US 10-year yield, let's overlay this. So generally it should do well when yields start to come down. And you can see why we see that sort of, big spike in terms of the 10-year gave us a sell-off, sharp sell-off in terms of the Russell 2000. Then when we see it come down heavily. So we see the stocks moving upwards once again. So we should generally see this moving in an inverse correlation against the 10-year, this market essentially. So if we see further downside coming into play in terms of the US 10-year, then we would likely see the Russell 2000 strengthen. But if we see the Federal Reserve coming out with a relatively hawkish tone and saying, look, we don't need to cut rates again anytime soon. We've already done 100 basis points. We think we, might see further inflation. There's a good chance we see the 10-year moving towards the upside, borrowing costs rise, and we see the Russell 2000 suffering as a result. But certainly worthwhile noting that as things stand, we've come into this 61.8 Fibonacci retracement. We've tagged it. We've rallied up through your resistance level here, which is around about 2291. We're pulling back at the moment, but there's a good chance that is a sort of retracement into this zone down here. But certainly this FOMC meeting is going to be particularly interesting for those small caps over in the US for that exact reason, because they're highly sensitive to borrowing costs. And if we see borrowing costs soaring or failing to come down in the face of interest rate cuts, then it's not great news for the Russell 2000. I hope this has been useful. Make sure to like and subscribe for more content from us here at Scope Markets. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.